If you've been listening to the show for a while, you know that I'm very interested in the topic of the economics behind real estate. Some of the reason for this is that the topic fascinates me, but also you have to keep in mind that my real estate career was born out of the most significant price correction in U.S. history. So I've always been intimately aware that you can have a solid real estate business and an investment thesis that makes sense, and the market can just blindside you if you aren't paying attention to the economics behind the business. I know a lot of people that had made a lot of money in real estate for decades, never lost a dollar, and then got absolutely devastated during 2008. However, there are also a lot of people that I know personally that our guest for today helped save or make them $1 million because of the accuracy of his predictions related to California. And for those that didn't know him or didn't take his advice seriously, especially in 2005, they certainly do now whenever they have the opportunity to. So it's really an honor to have him on, and I'm really looking forward to this conversation. So in this discussion, we're going to talk about what our guest believes is the single most important metric you need to know when attempting to time the real estate market. We're going to talk about how it's possible that we're simultaneously at a 50-year low in unemployment and also at a 10-year low in sales volume in California. This is completely ahistoric. We'll have a little conversation about that. Also, why has our guest focused on residential as opposed to commercial? I know that a lot of you investors out there are focused on commercial syndications. Well, our guest is interested in both, but has always just focused his career on residential. And given the amount of data that our guest digests on a daily basis, where is he currently investing and why? Now, before you skip this episode, let me be very clear. Just because our guest focuses on California does not mean that if you don't invest in California, this episode is not going to help you. We're going to discuss why that's the case during the interview, but for now, just take my word for it. Now, while we're on the topic of market cycles, regardless of what you think about how much longer this economic expansion can go on, we all know that eventually there's going to be a correction. And when that correction comes, you're definitely going to want to have some of your portfolio allocated to defensive strategies, most notably investments in recession-resistant assets like mobile home parks and self-storage. Of course, this has really been our specialty for the last 8 years or so at Cashflow Connections. So if you're interested, go to cashflowconnections.com, click invest, and you'll get taken to our investor portal. Just sign up and you'll get instant access to our current mobile home and self-storage fund. The fund has 16 assets which are already performing. We have more than 200 investors in the fund. They've invested a total of about $13 million. We'll probably keep the fund open until we've received about $15 million in commitments. So depending on when you listen to this, not that long, because we're constantly getting commitments on a daily basis. So head over to cashflowconnections.com, create an account, and let us know how we can help protect and grow your capital through these unique asset classes that I'm a huge proponent of. All right, hope you enjoy the episode. How's it going, everyone? Our guest for today is Bruce Norris, who is an active investor, hard money lender, and real estate educator with more than 35 years of experience. He has been involved in more than 2,000 real estate transactions as a buyer, seller, builder, and hard money partner. And he's well known for his ability to forecast long-term real estate market timing trends. This is in part due to his release of the California Comebackreport, which was issued in 1997. This gained him a significant amount of notoriety. The accuracy of the extensive report led many California investors to financial freedom, and I happen to know some of those investors. But perhaps more importantly, his January 2006 release, The California Crash, was an in-depth look at the California market correction and the statistics behind Bruce's predictions. He has spoken and debated nationally, been a speaker at a variety of well-known outlets, including national investment clubs, associations, and service clubs. And he's met with local and national governments, including FHA and Fannie Mae, to discuss market solutions and market insights. Not that those organizations always listen to his advice, but we certainly do. So, Bruce, it is an honor to have you on. Really appreciate it.
Andrew, thanks for the invitation.
So, obviously, we want to talk about market timing today. We want to talk about the nature of real estate and the market as a whole. But before we even jump into that, I want to hear more about your story for the listeners that aren't as familiar and how you got into real estate and then later how you really started focusing on market timing.
I mean, my intro to house buying happened in 1980. Somebody that knew me said, you know what, I'm working for a home buying company and I think you'd be good at it. So he kind of took me out and showed me the ropes one night. He had somebody that had responded to an ad, so I went with him. I knew nothing about real estate. we got into the house. Somebody had called because they were a motivated seller. There was a discussion that happened. In about 10 minutes, we got thrown out. So that was my introduction to the house buying business. When we got back to the car, I was just sort of sitting there as a bump on the log, but I was also from the world of sales in my day job. And I had watched the seller, I thought, actually comply and agree with the offer. But the buyer didn't catch that and kept on going and kind of unsold it. So I said, well, why don't I knock on the door? I'll get us back in. And I think she'll take the offer. And so that's what happened. And about, 3 minutes later, we knocked on the door, got back in, and we bought the house. And kind of a light bulb went off as I was driving home that night is whatever I have done in sales up till now actually applies to this concept, because I understand we each have a product. She has equity. I have cash. My stuff is cooler than her stuff, and that's why there's a discount. And I just understood that concept right away. And so I couldn't go to work for the company until I had a license. I took a crash course, got a license, went to work for the company, applied for the company. And the interview went like this: how long have you had your license? I said, 1 day. And he laughed and he said, there's no place for an inexperienced agent. And to that, I replied with a question. Do you mind if I ask you a question? He said, no, go ahead. I said, isn't the bottom line around here whether you can buy properties for a profit or not? And he said, yeah. I said, you'll know in 30 days I can do that better than anybody you have. And, what did he have to lose? What did he have to lose? He gave me a chance. I bought 10 houses the first month when I will never know less about real estate in my life. I bought 10 wholesale houses, made a year's worth of money. And I guess the rest is history. I just understood the concept right away.
Right. The combination of the physical assets, but also the sales component. A lot of people enter in the space as agents. And so there's that component of the transactional component, but then later, obviously, building wealth with real estate the dial starts to shift. Now, most of your career, you focused on California real estate. And obviously, I live in Los Angeles. A lot of these people that come to speak about timing, they're focused in California just because California is interesting, it's volatile, but also there's a fairly big overlap between California and the rest of the United States. So for the listeners that aren't necessarily investing in or even located in California, why is this conversation important in terms of it being a metric for real estate investors all over the country?
I think honestly it's more important in volatile states, to be quite honest with you. So California, since that's where my experience was, you asked originally why I had ever gotten into timing, is because I had a big project that went south in 1989. I had, in 1988, I bought 50 building lots and they were on lease land. I sold them in 6 months. I made $1 million. And I was pretty excited about that. So I decided to build 7 custom homes. I got done with them in June of 1990 and ran a full page ad to sell them. No one even called. It was crazy. So the market changed inside of that year so drastically that I could not give those homes away. So I eventually had to trade out of them and probably cost myself closing in on $500,000 for that experiment. So it taught me to respect the when-to part of the equation. So the other states, and I don't proclaim to be a timing expert anywhere other than California, but it's important to understand the cycles, because if you look at policies, you can see cycle change coming. So it's usually a reaction to something. So 2008 happened because of 2003, 4, and 5 policies on let's lend everybody money, whether they have a job or not. And naturally, prices got completely out of hand, way ahead of any metric we ever had to, bounce off and say, okay, we should be at the peak of the market. Well, we flew past that. And there's some states that happened to for the first time. So if you look at Florida's chart, for instance, Florida's usually a pretty benign state, going up pretty gradually and never having a crash. And then it crashed in 2008 along with everybody else. So timing is important, because if you don't get out in time, when you really have a serious downturn, you can give away years and years, maybe a lifetime of equity in a very short period of time. So I've learned to respect the when-to part of the market, not just the how-to.
Yeah, certainly, especially in those volatile markets. And so, even though California is kind of in a world of its own in terms of some of the major metrics that you would use, is it fair to say that the more volatile markets, because it's more pronounced, it can tell you more about where we're headed nationally? Or do you think that the, quote, national real estate market is kind of a misnomer in the sense that real estate's so localized, a market like California, or even submarkets of California can't really be predictors of the rest of the national market?
There's some things it is a predictor for. California, historically, when it goes up a lot in price, sends migration to the same states over and over again. So they're recipients of first California's money and then people. Mm-hmm. So that's a trend that you can say, okay, that happens every time. And how you can tell that's happening is you price a U-Haul going, let's say, from Orange County to Phoenix. The price of that, I think, approximately today is about $800. Driving to Phoenix to Orange County with a U-Haul, it'll cost you about $80. It's about the same distance, right?
Sure.
So it has to do with where the trucks are needed next. And they're not needed in Phoenix. They're needed in California. So when a U-Haul truck goes from Orange County to Phoenix, they have to hire a driver and drive it back. And that's why it's expensive. And that's how you can tell where migration is headed. So whenever I'm interested in an area, I literally play that game.
Wow.
I rent a U-Haul truck, go in both directions and see what the price is. And it beats the heck out of waiting for the next migration report because it's instant.
Yeah, fair enough. So I'm actually kind of interested. I will check around the U-Haul stuff just to kind of cross-check some of the theses that I've come up with. When it comes to real estate in particular, you know, I did study some economics in college and have been fascinated by the topic out of college. But one of the main things I learned in college is that with the study of economics, there's so many data points that you can use that it becomes challenging because you can basically make whatever thesis you want if you use enough data points. Or if you have enough data points to pick from, you can pick the ones that line up with your own personal biases.
Well, and you just said something really important too. If you really want to know the truth, don't start with a bias.
Right. So I guess that kind of lends me to a question. When it comes to the real estate market, there's many, many ways you can look at it, many metrics you can use. What would you say is the most important predictive metric when it comes to predicting a downturn, especially in single family prices?
Well, again, I'm going to speak from California because it's important to understand that it's probably different in other places. But in California, there's a repetitive theme. Affordability is an important metric that's pretty repetitive in California. So you hit 17% affordability in 1980, 89, 2005. 2 years after hitting that number, your inventory went in 1980, say from 3 months to 18 months. In 89, it went from about 3 months to 12 months. And then foreclosures went up 1,000% each of those times. And sales slowed and construction crashed and on and on. And it's the chart that tells me in advance something ugly is about to happen. So that's all I want. You know, I'm not really married to any particular chart because that happened through diligent study, trying to figure out where is the first domino chart, because I would really like to know that because I don't want to wait until inventory is already at 9 months on its way to 18 when it was at 3.
Right.
I'd like a warning system. And I would bet that every state is different. And maybe there's such little volatility, there really isn't a pattern that's significant. I'll say this about so I've debated my share of PhDs in economics, and I have a high school diploma. So in some areas, they're much smarter than I am. But the advantage I have with real estate is I lived through those years. So I can look at charts and I can tell you that, you know, without a doubt, 1990 was a pretty tough year. And so when somebody looks at 1990 and treats it as it's very benign, so you could look at a chart, even if you looked at a price chart from 1990 to 96, California went down a total of 12%. And so if you're an economist, you can say, well, that's really not a big deal. It's a 2% a year. Well, let me tell you something. If you owned the wrong inventory, and I'll give you 2 examples of wrong inventory, land or building lots and something like a custom home. My custom homes went down 35% in 1 year because it was exactly the wrong inventory to own during a week period. And land went basically to zero. Mm-hmm. If you're not in the market, you look at a chart and say, oh, that wasn't bad at all. Well, bull. And that's why it's important to have some real estate experience and street smarts with the chart so you can look at something and say, wow, that was painful or that was exhilarating. And having lived through it, you then can look at charts with open eyes and say, gosh, that's really the chart that matters.
Right. Or, you can look at it and say that is not painting a clear picture there because that 12% doesn't paint the picture of your experience.
It's very interesting. So think about unemployment. 1980, unemployment's 10%. 1990 to 97, it's probably a 7.5%. And unemployment at 2008 was again at 10%. So you had a replication of 10% in 1980 and 2008. In 1980, the down cycle actually went up about 3%, no down cycle in price at all. And in California, at 10% unemployment, we had 50% decline, say 2007 to 2010. Same unemployment number, completely different reaction. And 7.5% unemployment in 89, you had a negative 12%. So you start thinking, okay, well, maybe unemployment's not the main chart, not the main reason. And that's interesting. So also 10% unemployment in 1980s, 15% mortgage rates. Go to 2008, you got a 4% mortgage rate. So you can have a 15% mortgage rate and 10% unemployment and have no price damage. And you can have a 4% interest rate and have a crash.
Right.
That's interesting.
Certainly. And it comes back to affordability, at least particularly in the California markets. And I do like, you mentioned, well, there may be some markets that are not volatile enough, so it's difficult to use affordability as a predictive metric. But at the same time, one of the reasons I find it interesting to talk about California is that in those markets, it's likely not as important to time the market. And so your inability to predict the market is consequentially not as important. So
absolutely true.
Yeah.
Absolutely true. It's more important for a Californian, say you get near a peak where prices have been very volatile upwards, exchanging out of California to one of those benign markets that's not going to have a downside like California is a very smart exchange.
Makes sense. And just for those that aren't familiar, affordability, typically the definition of affordability there is the percentage of people that could pay a monthly mortgage with 20% down. Is that the same metric that you're using for as the definition of affordability? Correct. There?
Yeah, okay. California Association of Realtors, basically, yep.
And so that metric there is inversely correlated with price, all things being relatively reasonable. So meaning that the higher the price goes, the lower the affordability index is because less and less people can afford that monthly mortgage.
And here's the amazing thing also that goes along with that. In every other cycle, as affordability declines, so say 76 to 80, 85 to 89, 2002 to 2006, affordability goes down that whole cycle and volume of sales explodes as affordability goes down. Isn't that interesting?
Right. That's a good point. Meaning that people get excited and they don't want to miss out on the opportunity.
That's right.
That they're seeing everyone else make a lot of money in real estate. So as prices go up, the volume increases. The volume of sales increases despite the affordability going down. Right.
So it's much more than a math formula, affordability. It's definitely got a human component. So if you just did the math, you'd say, okay, well, people can afford less in 77 and 78 and 79, but yet they managed to buy more. So there's several components that are drinking the same Kool-Aid, buyers and lenders. Lenders usually go, isn't it amazing? We're getting aggressive on our loan programs and we keep on getting paid. So let's do some more. That typically happens.
Right.
And then all of a sudden it hits the magic number and it stops happening. Now, what's exciting about having understanding about a history of charts is that you understand right now is a very unusual cycle that we've never had. And that's usually not a sentence that you get to say. Never had. That's obviously not a very common statement. So we have never had 4% unemployment, which is at a 50-year low, and we have declining sales in California. We're at a 10-year low in sales with the lowest unemployment in 50 years. That's astonishing. We have really virtually no price gains, and sales are declining. And we have no inventory from lenders to mess up the comps. Foreclosure mix is 1%. It's non-existent. So that's a strange set of charts. Affordability is, instead of 17, it's 28. So you literally have never had this combination of charts. On a national picture, 10-year T-bill this morning is about 2.66%, full employment. And what in the world are we doing at 2.66% 10-year T-bill? And how is the Fed not able to raise the Fed fund rate to a normal level? And I mean, that's a head scratcher because that has never happened. these rates of interest rate that the Fed can't get past is concerning because they generally, when you have a recession, lower the Fed fund rate by 4.5% to 5%. It's pretty hard to do that when you're at 2.5%.
Yeah, absolutely. Or you have to go negative, which we've seen a couple of countries do.
That's right.
Yeah. So basically, it looks like California is experiencing some headwinds, but generally, when headwinds start, the affordability is much lower. So you're seeing headwinds in terms of the lack of sales, for example, lack of volume at 20% affordability or 28% affordability. So I guess my question then is, historically speaking, if it's peaked out at, let's say, 17% and the lowest or the highest affordability gets is, let's say, 40% or 50% in 2008, if we were to have a significant pullback right now, it would be one of the most advantageous times to buy real estate in terms of affordability in California, at least in the last 50 years or something. What do you think about that? Is that something that you're anticipating, or do you anticipate this 28% just kind of remaining at 28% as a market like, let's say, Tennessee would kind of do commonly, where they just balance out and don't really change?
Well, again, it's interesting to look at how great the charts are, and we're having basically a flat market. So what I'm anticipating is that when we have something other than a perfect set of charts, we may have a negative reaction much earlier than we have ever had before. For the last year and a half, I've looked at these set of charts and kept on expecting that boom in sales, the boom in price. And I finally realized it's not going to happen. And that was a real eye-opener, because I realized, okay, so what's different? I'm always looking at what's different. So 28 affordability normally kicks off a boom in price, boom in sales. This time it's not. What's different? Well, I think what's different is the lenders' policies right now are still restrictive from a historical perspective. It's not easy to get a loan. You actually have to qualify. But there's a couple of other factors that I think are behind the scenes. When I talk to lenders and ask them, okay, what is it that you consider, back-end ratio debt? And so, of course, it's the car payment and all that. But what's interesting? They don't count medical insurance, and they don't consider the deductible that is in place, and they don't consider daycare as an expense. But if you're the couple trying to qualify, you'd have to say you would count that. You'd look at your budget and go, our child care is $1,200 a month. Our medical insurance, $800 a month with a $12,000 deductible. And the lending world is ignoring that $2,000 a month, but there's no way you can, as a responsible adult.
Sure.
So if the lender's saying, we'll give you a 45% debt ratio to your gross income for your real estate payment, you wouldn't be making your other payments. Mm-hmm. So I think because of the cost of stuff has gone up so much, medical insurance didn't used to cost like this, and it didn't have the deductibles it did. And maybe daycare has been that expensive for a long time, but I just realized it. But it takes a big chunk out of people's budget. I'm not sure that was true before.
Interesting. Okay.
So I think that 28% affordability may be the new 17.
Wow.
With the lending policies that are restrictive. Yeah. Well, I'm trying to think, why are we having this reaction of charts? And, I've learned to respect what affordability tells me. And so I'm landing there thinking, okay, what would make 28% react this way? And that's, just kind of thinking about it. It is different getting a loan this time. Not just from 2005, but from 1988 and 1978. It's just more restrictive. If you're self-employed, good luck.
Yeah, unfortunately, or fortunately, for different reasons, I certainly am, and it's going to be a challenge when the time comes. So just to kind of reiterate, if 28 is the new 17, then likely we would not see that significant increase, and particularly not a parabolic increase in prices. And so if that happens, maybe the downside is also equally protected. Would you say that that's reasonable in the sense that
yes,
if we're okay? So
yeah, you'll have a less volatile ending this time. The chart that matters most to damage for price, in my opinion, is the mix of foreclosures in the marketplace. So going back to 1980, you have 10% unemployment and 15% interest rates. you have 1,000% increase in trustee sales, but the trustee sales never became greater than a 27% mix of the market. So in practical terms, what does that mean? It means that when an appraiser appraises homes in 1980, 1 out of 4 comps is an REO.
Right.
As an appraiser, you can look at that and say, that's really not the market. That's an abnormal comp. We will ignore it. And they do. In 1990 to 96, it became 40% of the market. Now 4 out of 10 comps or REOs, you have to pay attention to what it's saying. In 2008 in California, 80% of the comps were REOs. It was the market.
Right.
So if you want to go where price damage is occurring, that's the only chart I would need for existing price damage and motivation of sellers is give me a state that's inundated with foreclosures where it represents a great deal of the percentage of sales. And I know there's bargains. There just has to be.
So you mentioned trustee sales as another indicator that's important. What are some of the other indicators that you pay attention to other than affordability?
Well, just to be clear, trustee sales it doesn't initiate anything. It reacts to stuff. So affordability getting to a bottom all of a sudden creates sales stalls because lenders, if they're doing their job in a legitimate lending world, say no a lot more. So that sets off a chain reaction. All of a sudden inventory grows. Inventory grows, prices stall. Prices stall, builders stop building, lay off people migrate out of California. So that's sort of the domino effect. As prices stall, all of a sudden everybody that was behind in payments stop being able to get the benefit of ever increasing equity and being able to refi. And there you go. Now the NODs convert to trustee sales, convert to REOs. That's basically the chain of events, and it takes only 2 years to show up.
Got it. Well, you mentioned the lending market. So right now it sounds like your perspective is that the lending market's quite tight. Do you anticipate that changing, or do you anticipate that given the legislations that were put in place after 2008, that this is kind of the new normal, and that, I mean, of course, things are going to go in the state like they always do because people are involved. But has something been put in place that makes it a little bit more permanent this time in terms of the tightness of the lending market?
Yeah, absolutely. We've got an annual event every year at the Nixon Library, and on a panel, we usually have the president of the Mortgage Bankers Association. So it's a very interesting conversation. Chief economist Fannie Mae will be there, Doug Duncan, and talking to them about lending. So when is lending going to cut loose? That's maybe a question I'll ask them every year. Is it going to get easier? And the answer so far has been no, it's not. And here's the reason. Lenders are very afraid they will have to buy the loans back. They cross every T, dot every I, and if they think that loan might have to be bought back, they just say no. That's a very different lending environment than anything that we've had up till now for my life. Every other market had some aggressive lending, and maybe as prices went up, a pretty healthy percentage of the business was adjustable loans. Well, right now, we really don't have that. You have the market's very, very much fixed rate loans. Huge percentage of the market is like that. Stated income loans are not really existing to any great extent. So we have a very conservative lender. We have a very conservative borrower. The one thing that's going to be a big help if we have a slowdown and we, have job losses and stuff like that is it's a very odd thing that this cycle, we have not extracted our equity. You look at an equity chart, we owe less on equity lines in 2019 than we did 10, 12 years ago. So we had this doubling of price in basically since 2012, and we've not extracted one dime of equity to go play. That's very unusual. So either people have learned, which I doubt, because we do the same stupid stuff over and over again. That's the nature of people. But lenders are the ones that have stopped that. So it used to be I could get an equity line on almost anything I owned, even a rental. Pretty aggressive line, something worth $400,000. You could get a 320 line of credit, just have it sort of like a checkbook waiting to write a check off of. Now it's much harder to get that. I have one loan that I did a refi on a rental home for a very specific reason. It was really to protect myself from having a total loss because of who occupied the property. I have a family member that is mentally ill. And so I realized, okay, this could be a problem because he could do something and I would have risk because he is occupying my house. So I borrowed money. I have everything else free and clear, and income and cash and all that. It took me 100 days to get a yes answer with an 860 FICO score, by the way. So I thought, wow, if it takes him 100 days to say yes to this, I'm wondering what the heck somebody with a normal circumstance and a debt ratio has. So I don't know that it's going to get easier because they're afraid. They're really afraid they're going to buy back the loan.
Yeah, I actually really appreciate you sharing that anecdote because that is really what is going on out there. I have a friend that is very successful. He is self-employed, but he had a real problem getting a loan, had to put a huge amount down. And that right there, it's not just him, right? And it's happening all over the country and particularly in markets that are a little bit more volatile. And it's pretty fascinating. So yeah, I appreciate you sharing that.
Yeah, if you want to change 17% affordability being, normal, and now 28% is reacting in that way, yeah, that's all you have to do is change lending policy. So what if tomorrow morning we woke up and said, okay, well, the new required FICO score for all loans is 800. Well, then your affordability number would probably be 35 or so, just because it would match what the lenders are willing to say yes to. So all of this is always subject to policy. That's one of the things I really pay attention to is what is coming down the pike that will have a big impact. So California, we have something called Prop 13. Prop 13 is a guaranteed lower tax bill. I have friends that have rentals for 30 years. The next door neighbor who bought their house in 2018 has a tax bill of say $5,000 and they have a tax bill of $800. That's a gigantic savings. So they've owned it for 30 years and it can only creep up so much. If they change that rule, and they're working on it, see that rule is about to change they're calling it a split tax roll. So that's on the ballot for next year. Split tax roll says that, okay, on commercial and apartment buildings, we're going to say that it has to be reevaluated every year. And by the way, it has to be reevaluated no matter when you bought it. So you'll have some apartment owners, if that passes, have an apartment building that literally is 1/4 or 1/8 of the tax bill that their neighboring apartment owner is because he bought it recently, and they're going to have the tax bill that guy has. That will drastically affect the value of that asset. It'll also drastically affect the vacancy rate of commercial buildings because usually in the leases, if you have a lease that's the way it's typically written is the tenant will absorb any hike in tax bill inside of their rental agreement. Well, if that goes out of whack, you're just going to have businesses walk away from their lease.
Interesting point, especially on those triple net leases. Those are almost certainly included.
That's right. So that's why paying attention to what's going to change legislation-wise is real important to understand. That's going to affect what happens to the value of some of your stuff. Now, they're not going to be able to do that to single-family homes yet, but that is the ultimate goal, by the way, is to do that.
Interesting. Let's transition away from regulations in the lending environment to construction, because I definitely want to discuss this. It's obviously an important part of the cycle. It's the way that you do, it's like the way that I look at it is that you have the economic cycle, you have the lending cycle, and you also have the real estate cycle. And the real estate cycle, I kind of compartmentalize that into the fact that you can expand and contract the supply of housing. And the way you do this is through construction. And then you have the absorption that takes place and then the overbuilding that takes place. And you have this internal cycle that's going on just particular to real estate. So I wanted to give the opportunity to discuss, first of all, what does new construction tell us about where we are in the cycle? And what does the current data suggest about this particular cycle?
For California Builder, it suggests that they are scared. We have nowhere close to the amount of construction that we normally have during what I would consider a healthy cycle. We are currently building, say full year 2018. So in a year of very low unemployment, no foreclosures, you are building exactly the same amount of homes as you were in 1981 when construction loans were 20.5% interest. That's true.
Not adjusted for population growth.
I mean, not even, no, it's exactly the same construction number. So it's even worse than 81 by far if you started considering how many people could potentially buy a new house. So we interviewed the president of the Builders Association, California Builders Association. I asked him, I said, I keep on hearing that we're not building, we're like 100,000 units short a year or something. Well, does it seem to me did the builders not know that? That they could build another 100,000 homes profitably or something? Is there something missing in the data and the reality? And he said, well, here's a question that you would ask. If you're a builder in Texas, you would ask this question: what's the economy going to be like next year? In California, the question is literally, what will the economy be like 15 years from now?
Why is that?
Why is that? Because of the regulation to get anything passed. I have a personal example. A friend of mine had a huge parcel of land, 1,500 acres, in an area where population pretty much caught up to it. So it was worthless farmland forever, and now all of a sudden, it's the next piece of land that could be developed in a super tract, okay? Mm-hmm. A builder put that pending a decade ago and released $250,000 on an option per year for 10 years, trying to get a project approved, and never did. He walked away from $2.5 million of money committed and never got to a finish line. That's California. So you want affordable housing and prevent it in every way possible. It's so funny that this came up. So we're building a home. We're trying to get to the end line here. We have it sold and we're delayed. So here's a little delay from what we wanted. We're still working on the electrical situation. And then this lady, this wife of the builder. So there was an electrical pole that we had to get to satisfy Edison. We were told to take 2 or 3 weeks to cure. Now, this is after Edison messed up and didn't tell us we were going to need one. So we waited 3 weeks only to have it snap in half as they delivered it. So, I mean, you just get things like that delay, or the people aren't doing their job. So that's probably a big impediment for builders. If builders are confident, they create subdivisions. That's another way you can test the mood of a developer. So typically, let's say in Riverside County, you're creating 120 subdivisions a year during good times. We're creating 30. So again, with all this employment and prices going up and all that, you are at 25% of lot creation, which is very telling. It means that the developer is looking out saying, how long is this going to take me to get to the finish line? And the truth is, I don't really know. And it scares them. So I think they just say, you know what, we're going to do it somewhere else.
Fair enough. And I definitely want to talk to you about some of the opportunities in other states as well. Let's transition into commercial. So a lot of our listeners are commercial investors to a certain degree, self-storage, mobile home parks, office, apartments, etc. I know that your focus is typically in the world of single family, but what are your thoughts on the world of commercial right now, and what are you seeing in that space?
I will admit to not really completely understanding sometimes the things that I see, and I don't understand some of the vacancies I see. Give me an example. The building that I bought originally sold for $950,000. I waited until the price crash happened. I sold my building. I leased the building for 4 years. I bought my building at $319,000. So basically a third of what it sold just a few years before that. But behind me is another building that has literally sat vacant for 8 years. It was brand new 8 years ago, and it has literally never had a buyer or a tenant. And it's been available the whole time. I can't say I understand why that's occurred. That type of thing, that's commercial is weird that way. You can definitely have some odd occurrences where you just go, wow, I think that vacant building's been there for a year after year, and it's true. The other thing that's interesting, now we'll talk about apartment owners. I do stand in front of them once in a while, not being an apartment owner, but the crowds have gotten bigger and bigger when you speak in front of apartment owners. And one time it was ridiculous. I would say normally the crowd would be 300 people, and it was 450, and they were lined on the wall. So think about standing in front of an audience that normally fits in the chairs, and this time they're literally lined on each side wall and the back wall. And you're just going, holy mackerel, what is going on? So I asked him, I said, you guys are either really excited or really scared. And they had a little laughter, and somebody stood up and said, we want to know if apartments are in bubble territory. I said, I'm not an apartment expert, but I can ask you guys one question and you'll tell me. How many of you would buy your current apartment building at today's value? And it was rolling laughter. They were laughing at the idea of buying their own property at such a ridiculous price. And I told them, I said, that is the definition of a bubble. All of you know the price is completely ridiculous. You already know that. So you've answered your own question by your reaction. Now, why did that occur? Because there's a chart in 2008 that the foreclosures was 80% of the market, and we had way more people defaulting than we ever foreclosed on. We just stopped foreclosing. But the damage to credit was done. Took them 3 years usually to get people out. And then there was a 7-year period that you couldn't get credit. Fannie Mae would not lend to you. So do the math. 2008 plus 10 years, where finally all those people that were foreclosed on, now they got a job, their credit has been revitalized. Fannie Mae will now lend to them in 2019. I would not want to own an apartment building knowing it's completely overpriced, and the huge amount of tenants that showed up for the last 10 years might decide to go buy something, if not in California, somewhere else.
You mentioned apartments. Are there any other commercial assets that you're bearish on?
Again, this is not my niche. What's interesting about what's going on in Riverside is the amazing building of industrial space. So that's a complete boom. I'll just mention that. I mean, we drive sometimes to areas we haven't passed all the time, and all of a sudden there'll be a 500,000 square foot building for lease. And you're just going, my gosh.
It's massive.
Crazy. So
yeah. It
is. It's massive, and it's like built on spec, and there's not one of them. There's a bunch of them.
Certainly. And
I guess go ahead. How people shop, I mean, wouldn't that be how people shop now? I wouldn't want to own them all.
Right.
That would be concerning.
For sure. So here's something, and a couple more questions, and we'll wrap up. But I mean, obviously, I can't get enough of this. We could do this for 5 more hours as far as I'm concerned. But something that I've talked about a lot on the show, and something that is on most investors' minds, is this idea that a recession is always coming. And we're looking at things like the spread between the 10-year and the 2-year, for example. And obviously right now it's not a major concern, but there was a time a few months ago where that was on everyone's mind. And basically what I'm trying to ask is, we all know that a recession is coming. I think what I'm much more concerned with is what this means for real estate. And what's your perspective on that, given the changing in the lending environment? If we do have a recession in the overall economy, let's say 2 quarters of negative economic growth, what does that mean for real estate prices?
Oddly enough, I don't think it'll be anything devastating, because if we have a recession, the typical reaction is to lower interest rates. We would be the one industry that actually might fare very well, because if you were in the loan business and say you got your mortgage rate back into the 3s or the low 3s or even the high 2s, can you imagine how busy you would be with refis? I mean, it'd be completely nuts. Every time you got a refi loan closed, you probably saved that household hundreds of dollars a month so they can pay for their insurance and stuff. So I don't know that you'd have a price increase just because you have lower interest rates, but I think real estate would be pretty protected territory in the next recession because of our starting point in interest rates. We're only at 4.5 or 4.25 right now. So your affordability factor that's in place is pretty powerful. You have people with fixed rate loans with real money in it that really qualified. The odds of them losing that to a foreclosure, and that foreclosure mix becoming too high of a percentage, I don't see those dominoes falling to any great extent this time. I just don't.
Agreed. And that's really why I'm just such a fan of real estate as a way to protect principal, because the way that you truly lose in real estate is you lose that principal through some sort of foreclosure process. And of course, there's things that can go along, your friend that lost $250,000 a year for 10 years. I mean, that's a unique situation. But for most investors investing in cash flowing assets, for example, the way to do it is to do something incorrect and over leverage. And if you avoid that, you're significantly reducing your downside in a real estate investment.
Absolutely.
Especially compared to the other options that are available.
Yeah, that's having a lack of debt and a positive cash flow. It just makes you less vulnerable to anything, even if there's some really bad times. I mean, what was interesting in 2008, we had very experienced investors handle 2008 downturn very differently. You had people that had methodically gotten the correct rental properties in the cities they wanted, knowing full well the price was going to get cut in half, made no effort to sell it at all. Just like, who cares? I'm still going to get my rent and I'll own it and the price will come back. And, sure enough, it did. And yet some people, they were better suited to sell their properties. And usually the difference was that the second person owned properties in rental areas that were tough. That wasn't like hand selected, I'm going to own this forever locations. It was, I get to buy it cheap and it's going to go up and I'm going to cope with the fact that it's a lousy location. And it's the locations that go down in the next downturn. So selling those types of properties made perfect sense because you could cash out tons of equity and do something else better with it. The people that methodically got really good properties in really good locations, they own them for a different reason. They just want the check every month.
Certainly. So that kind of lends us to the next question there, which is your current investing strategy. What are you currently looking at and how active do you anticipate being in 2019?
Oh my gosh, more active than I ever expected, to be honest with you. We've made an arrangement with a Florida builder to do about 100 spec houses this year. I'm about 2 days away from traveling to Florida with a whole group of investors, and the builder is going to be building some of them houses. Florida is just one of those great states that has obviously big tax advantages if you live there, but their prices are still just very, very reasonable compared to where we are in California. So most of the people making exchanges with their California rental will increase their net income probably 50%. And they'll go from a house that's 40 years old in a bad location to a brand new house in a good location. The biggest reason I'm interested in Florida is their business model. Their business model is seniors showing up, and there's a reaction to when a senior shows up, there is a guaranteed inflow of nurses and other people that are involved in taking care of them. And the multiple over a 20-year period. So if you're a senior at 65, you have 2 medical people in your life. And at 85, you have 3.5 times that. You have 7. I just like the fact that I have guaranteed migration of people that have really good jobs. That's, to me, the safest business model there is.
Agreed. I'm very bullish on the Florida market as a whole. Are there any submarkets or any cities that you particularly think have the opportunity?
I'm not a Florida expert. Maybe I won't ever be, wherever seniors are headed. So where we're going, there's an area of Cape Coral. It's the #1 destination of seniors. So I'm interested in that because they show up and there's a reaction to it.
Awesome. Well, Bruce, obviously we covered a ton of content. Just for the listeners who made it through all of this awesome stuff and stuck around and learned a ton, I'll just tell a quick story. When I was just a young spring chicken, I think it was probably my first 5 or so real estate events that I went to, I got the opportunity to see you speak. Didn't know much about you, didn't know much about real estate as a whole. Unsurprisingly to listeners of the show, I had some pretty strong ideas of my own. And I asked a question that was kind of, I don't want to go into the details of the question because it's just ridiculous and unnecessary. But anyway, I asked a question that was kind of counter to some of the points you made. And then I again asked a similar question just to kind of reiterate after the Q&A had been finalized. Anyway, long story short, you ended up being right. Without going into the details, I can promise you that. So anyway, I wanted to thank you, Bruce. It's been an honor to have you on the program and definitely have to do it again. Before we jump out, let the listeners know how they can learn more about you and your company and what you guys do.
You can just go to the website, thenorrisgroup.com, and 10 years of radio shows talking to the brightest people in real estate. And whatever speaking schedule we have, it's all there. So there's a lot of free education there too. So yeah, take a look at the website and be excited to have your feedback.
Awesome. We'll make sure to link to that in the show notes page. Bruce, I really appreciate it.
Hunter, thanks a lot for the interview.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.